All right. This is as fancy as I'm going to go. Then we can start.
Great, great. Anyway, so let me introduce you for the podcast, and then we'll go from there. All right, so welcome to another episode of our podcast, Investing in Real Estate in the USA. Today we have another guest. This is Joe Berko, CEO and founder of Astor Realty Capital. How are you, Joe?
Wonderful, wonderful. Doing great, Luis. Thank you for having me.
No problem. When I saw you in New York a couple of weeks back, I said I have to have Joe Berko as an interview, for our podcast for sure.
Okay, I appreciate it.
Yeah, definitely. So let's get right into it because I know that you're busy, and I don't want to take a lot of your time. So I wanted to share it with people that are listening to us and that are watching us as well on YouTube. I wanted to share about your journey, because I understand, I saw on your website that your company was founded in 2016, so like 7 years. It's going to be eight years, in a couple of weeks, I guess. January. So, but I wanted to ask you, like, to share that, like, how do you come about Astor, and what was your thought process? What's your experience in real estate before that and after that, I guess?
Sure, absolutely. So in reality, I started in 1995. This is when I first picked up a real estate as a business and as a career. 1995, New York City, Queens, New York. I was a real estate shower. My job was take the clients, show them the apartment, bring them back, say absolutely nothing. Unlicensed real estate shower. You're not allowed to talk or negotiate. I liked it. And within a couple of months, I decided to look for the broader avenue of real estate. And so I signed up for a new program at the time. It was a 4-year degree called Real Estate and Metropolitan Development in Baruch College, the City University of New York. I devoured every available book. I used to be so passionate, and still am, about anything that has to do with knowledge and learning about real estate. We learned about real estate law, we learned about real estate development, we learned about real estate finance, valuation, you name it. Everything was real estate morning to night. And eventually when I graduated, unfortunately, it was right after 9/11. 9/11, the city of New York was distressed. Twin Towers fell down. You couldn't go below 14th Street. Companies were leaving New York City. I remember the conversations. People felt that New York was done. Goldman Sachs was building his headquarters away from Wall Street across the river in New Jersey, 2 million square feet, in order to consolidate 5 different large office buildings and remove all those employees away from New York. The stock market was in a complete shock. The grid falling off. It was a real blow to downtown Manhattan and the financial district of New York City. And so it was impossible to get a job. It was impossible to get a job. And so I picked up through the newspapers and online ads, eventually a shop that said, hey, we're financing apartment buildings and we're looking for more agents. So I felt like I'm going back to what I knew best, which is the kind of like the advisory brokerage world. And I signed up and I started doing real estate financing for buildings. Your building has typically a 5-year mortgage. Come 5 years, you have to refinance whether you like it or not. And so it's kind of like a necessity type of a business. And so I started helping property owners, real estate owners, commercial property owners, not residential, but commercial property owners, refinance their properties and advise them through the refinancing process. One of the investors, property owner at the time, as we were going through the process of refinance, approached me and said, look, I don't think I want to refinance. I think I want to sell the building. It was kind of like, early 2022, 2023. And so I said, great, I can help you with that. And so I put together a marketing package and went out and sold the building. The buyer I helped refinance and actually finance the property, the purchase. And so I sort of like determined that we got 2 hands here and we got the capacity to understand, to evaluate, do all of those different things. And so I started selling properties, commercial properties, buildings in New York City and financing them. And at the time, it was quite unique. A couple of years later, I opened up my own shop, Berko and Associates. I started representing large companies, larger companies, public companies. Companies will come to me and ask me to help them evaluate an asset, evaluate a transaction, sell shares of a transaction, raise capital. I've done all of that, and I started creating a reputation for myself based on what I called Shem Tov, good name. And so over the years, my transactions grew larger. The type of clientele that I had, type of assignments that I would take became very, very large. Whether it was, it was never run of the mill type of a project. It was always kind of like something with some sort of a twist in it. It was a large scale of office building, but it was like 40% sale of it. It was kind of like the stuff that a lot of people didn't know how to underwrite, how to approach. And I developed that skill over the many years. Eventually, in 2009, I was approached by the Secretary of the State of New York, and she sort of like pursued me to become a member of the Real Estate Board of New York, of the State of New York, for real estate matters. And kind of like sounded like a lot of fun. And then she gave me this 400-page application with fingerprints, and I have to show my tax returns. Like, I'm not doing this. Thank you for the honor. That's just not going to happen. I'm not that kind of a guy going to sit here and start filling out 400-page reports and open up the kimono. But she was like, look, we're not going to have it. We have to do it. We want you on the board. And so I went through it and became a member of the board of the state of New York, representing the state of New York and the public of New York for all real estate matters. It was supposed to be a 2-year nomination, and that turned into a 9-year nomination until I eventually left to Florida. But it was a lot of great experience. So for many years, I would represent a lot of companies, large, small, and even on institutional level, the state of New York for many years. And so that's kind of like my journey until 2014, where I decided, 2014, 2015, when I decided to pivot away from the advisory work and open up my private equity shop, Astor Realty Capital.
What made you go there? Like, what made you pivot? Like, was it something that happened, or something that just happened in your life, or you just thought, this is a time?
A great question. It's a couple of things, actually. If you think about the world, right, as a business owner, you always have to kind of like project things a few years out. I'm an Aquarius, right? I live in the future anyway. So not only I live in pro forma. So I was looking at the world, and I asked myself the question: where's the industry going? Where's New York City going? Where's the state of New York going? Where's the industry going? And so I looked at the industry. At the time, I had like 25 different associates, agents, analysts, and so on. And I looked at the industry, and I've been noticing for quite some time that, there's been every year more and more capital, billions and billions of dollars being thrown in to disrupt the real estate industry, right? From Silicon Valley, from Wall Street, real estate has kind of like been this industry that's been kind of like without a lot of technology, and it's been sort of like a very, very personal type of business. It's an inefficient business, right? As opposed to, let's say, buying a stock. You and I can agree that, if you buy Apple today at this 4:22 p.m. and I'll buy Apple at the same time, we'll both pay the exact same amount.
Sure.
Real estate is not like that. It's an inefficient market. As an inefficient market, what I know and the knowledge that I bring to the table is proprietary almost to me, because I know the seller with the office building that has a lot of pain. I know him personally, and you may not know it. He might be in the same market, you and I, but you may not know that he's got this type of a pain. And so what I know essentially will represent how I'll approach it, how we'll price it, and things like that. And so ultimately, I've been watching how Wall Street is pumping money to disrupt the environment. And by doing that, providing so much available information and so much available information to all the buyers and sellers. And today, I would argue that, buyers and sellers in the world of real estate transactions have access to all information. They have the access to everything. And yet most understand the value of almost nothing. And so with that availability of information, the view of buyers and sellers, of the real estate intermediaries, the brokers, the advisors, has been diminished, right? It's been exceptionally diminished. And so,
You mean, what do you mean? So do you mean that the value that they bring is diminished, or the knowledge
exactly,
that they bring is diminished because of that, because of the information being available?
Yes, exactly. So
Okay.
the value that the perception of value, no, I don't think that the value is diminished, but the perception of value. We used to go and pull information. We literally used to go to downtown, sit there for hours and hours and pull information from the city department records, and then pile this information and analyze this information and present it when we were doing a pitch, right? If I got a building for sale, I will come up with all the comparable evidence and do my presentation based on value that my competitors or my, the person I will be pitching to will not have the access. Now, the information became so widely available, you can access this information in 2 clicks of the mouse. However, it wasn't just the information that made brokers valuable. It was how they analyzed the information, how they intercepted, how they understand the information. And that part was missed. But in the perception of buyers and sellers, since they have access to the same information, analysis is so much secondary. And so we'll pay brokers a lot less. We'll need brokers a lot less. The reality is that's not the case. I believe it's not the case even today. There's no, the intermediary, especially in commercial real estate, is a lot of value. If you think about the residential real estate, right? Residential real estate,
right.
Especially things that are easy to do. Rentals, for example. 10, 15 years ago, there was never almost a situation where you would have a building and they would have like in-house leasing office and stuff like that. Most of the transactions were done by the leasing brokers, right? Were done by the rental brokers, right? They would control who the buyers are, and they would walk them to different buildings because they knew they had inventories. They get sheets of papers, they get faxes. It was a lot of work. Now everything has become so easily accessible that anybody can sit down and pull the information very quickly and determine this building, studio is $2,500, the other building is $2,800. I'm going to go to the first building.
Right.
However, in commercial real estate, it's a lot more complex. But nonetheless, I've been watching how the industry is getting disrupted. So much money coming in. Wall Street is creating a lot of technology. And I decided to take a little bit of a break. It was actually after my largest transaction. It was November of 2014. I closed the largest transaction of my career, $182 million office building sale. And it was a very tough transaction to try and negotiate between both parties. They had no respect for themselves. They had no respect for their attorneys, certainly no respect for the intermediary or the advisor that put this deal together. Eventually, we got this deal closed. Well, $182 million. I was walking the next morning towards the bank to deposit the check. It was a big 7-figure check. And I was really frustrated. I was really done. I was really done with the industry. And that was kind of like the catalyst that started me thinking that things are changing, and they have changed so much that maybe it's time to reshuffle how things are going. And ask myself the question, if I had to restart my business again from scratch, will I do it exactly the same? And my answer was no. I'm not as happy as I once was. It doesn't give me enough fulfillment. And I think that the industry will continue getting disrupted over time. Certainly in New York City, commercial real estate. And so ultimately, I decided that what makes me happy was to work with people that appreciate the work that I do for them, and that I can see some rewards out of it, more emotional rewards, not just financial rewards. And so, the second thing is, if people don't evaluate the advisor as much, what is it that they value? They value, what they need is basically capital. Everybody needs capital. It doesn't matter if you're a Blackstone. It doesn't matter if you're a local family. Everybody's raising capital. Everybody's in a money, in a capital raise type of a game. And then ultimately, I decided that, we're going to switch over from the advisory side to private equity. And I said, if I'm happy with doing that, and if I'm such a great advisor, why not put my money where my mouth is, and whoever wants to join can join. And that's how I opened up my private equity.
Okay. But so do you think that had to do something also being in New York, and because I'm in Texas, and everybody's friendly here. Everybody's like howdy and all that, basically, you know.
Right.
Whereas
Right.
in New York, it's like, you know, you don't have time to do anything. You just have to like walk and like run and like, you know,
Absolutely. You ever
like,
saw New Yorkers walk? It's kind of a very
you
different.
know, I was, when I was in New York, man, people just ran. They didn't walk, they ran,
Yeah,
right?
yeah,
They didn't,
yeah.
that's what you see, that's what you feel. I guess you being there for you is just normal, you know,
Yeah.
but me being in Texas, it's like, you know, it's more laid back. Of course, here nobody walks really, you know, everybody wants to
Yeah.
everywhere
Everybody drives.
in their big ass trucks, you know,
That's right.
and it doesn't matter, right? But what I'm saying is that, do you think being in a place like New York actually, I would say it didn't push you, but it helped you make that decision to
Mhm.
go to, like, you know, this, get out of this soulless environment and be more in a place where you had like heart and like, you know, let's do it together type of thing.
Yeah. Certainly the environment makes a difference. But by all means, and you know that is not to say that New Yorkers are not nice, and some of them are not. New Yorkers are sort of like passionate about making things happen yesterday. The
Right,
environment is so quick and
right,
so on point that in order to compete in that market, you have to work longer hours, you have to be quicker, you have to outsmart your competition. Consider it the most competitive market in the world. I don't think that there is more competitive market than New York, not London, not Paris. There just simply isn't. And you know, cut your teeth in that market. You know, you're something gives, right? Something comes out of it on the other side. And so, look, I'm a very competitive guy, but I'm also learned to be a very fair guy. You know, so I don't believe that one should kind of like compete with the other. You can be both. That's how I built my career. This is why I think, you know, after 28 years in this business, we created a great name for ourselves. We are liked. We get a lot of opportunities because of that.
yeah,
And I wouldn't change that. I wouldn't have it any other way. Does it mean that I was kind of like the fastest gunslinger in New York? No, I wasn't. I
yeah,
wasn't. I gave up on a lot of transactions. I could have made tons of money if I would just accept certain things that were different than my absolute values. But I don't, you know, I don't think that I would do it any other way. I mean, it's not that I don't think. I know I wouldn't do it any other way. At the end of the day, you want to go home at night. You want to have a nice conscience. You want to know that you've done your best. When you gave your word, you actually stuck to it.
yep,
You know, for me, I mean, you know, for me to be happy is not when I make the most money. Right? Of course, it makes me happy. But for me, the happiest moments is when I'm able to turn back to my investors and say, here's your money back. We made better than expected. And the results and the comeback that I get, the compliments that we get, not just me, but also my team and my group, you know, it's warm and fuzzy to such an extent. You can't buy this type of a feeling.
sure,
And that's what we seek for, right? Every company has a why you started a company, right?
yeah,
That's our why. You know, I started a company because I realized where the dislocation in desires and needs are. I know how to bring institutional level quality investments and give it to not just the institutional guys. We're backed today by a public company, but we always allocate about, you know, 15, 20, 25% of our capital to friends and family, you know, the high net worth, the retail investors, and they come in and they enjoy being side by side with very large name companies and very large name projects with small capital, you know, but they get the same reports, they get the same kind of expertise that the large companies have access to. And so I think that's unique in that respect. I call it the collective bargaining tool. We can talk more about this maybe some other time or
yes, that's pretty good, that's pretty good. That's
yeah.
yeah, definitely, for sure, we'll talk about that next time, because I know
Mhm.
that I want to get to the next, that was actually the first question.
Sure.
I only had a couple, but that was actually the first question, and we took like 20 minutes. That
Sure.
was good. Anyway, so let me get to the second question. I wanted to ask you about a challenge. I wouldn't say challenges because there are so many, but is there a specific challenge that you found that if you had to think back, you would say like, man, that was a difficult time, and I overcame it doing this?
Yeah,
What would be that challenge, and how did you overcome it? And like, what would be the lessons in that?
of course. I'll give you one particular challenge that it's probably one of the strongest challenges I had in my career. And it has been a challenging career. Every time there's a downturn, every time you work on a deal, it blows up. There's always challenges. There's always this kind of like this up and downs. But around the Great Recession, if you will, 2008.
Yeah.
2008 represented a very tough year. 2008, 2009. Prior to that, you threw a rock anywhere in New York, you would hit a building and you would sell it. Money was available. It was pretty euphoric. We would sell buildings left and right, and with finance properties. It was just so much business to do, And it's sort of like the music stopped, and when it did, it stopped in a second. The challenge was staying afloat through a period where business drops to the tune of 90%. And it doesn't really drop like, oh, it's 100%, now it's 70%. Okay, you can do it. But 90% drop. I remember a point in time, I'm coming back to my office, we had a closing in a few short days, and the bank would not pick up the phone call. We would call and call and call. It was right after Lehman Brothers had announced that they're closing up shop and they're going bankrupt and all these different things. I remember calling banks, and it was pretty eerie. You wouldn't get anybody to pick up the phone. It was just nobody on the other side. That was pretty bleak, right? So it wasn't like from 100 to 70, it was from 100 to 90% drop. And that was pretty rough because all my money was in real estate. Every time I would close a large deal, a certain amount of that money would go to seek an asset or an opportunity, a partnership, one of those things. And I found myself, with a lot of assets and very little capital. And it was, nerve-wracking. I had 2009, I had my second baby. I had a mortgage, you name it. Everything was kind of like going in opposition, and it was so tough. And we came out of it, and the biggest lesson learned, and thank God we came out of it, and we've never had any significant losses, but we were really down. The cash flow was extremely down, and we were kind of like from 1 month to the next, or a couple of months and stuff like this. It was just very hard period of time. And what I've learned was that, as much as we understand, we love real estate, we want to invest in real estate, and we always do, you always have to remain somewhat liquid. So you got to create some capital that sits there for kind of like a black day, a rainy day. And you got to put this aside. You want to make sure that you have proper liquidity. And then you want to make sure that you're building the future, that you invest in bricks. Real estate is an illiquid market. When the market drops, the last thing you want to do is try and sell. Like this particular moment in time, we don't want to sell anything, right? The market is absolutely at the bottom. We're at the absolute bottom. So I think that that's one of the biggest lessons learned is, make sure that you are prepared for any type of scenario by keeping liquidity, by making sure that you have money tucked away for long-term, like real estate projects, illiquid stuff that can grow and make you a lot of money, and also make sure that you are that you certainly are enough there to make sure that you can move on and make good even if the market changes.
Mm-hmm. Have you found in the position yourself of making capital calls to your investors, like asking for more money?
So in our investment documents, we do not have capital call. And I'll explain to you what we do. So every deal that we invest in, the documents would read, in the event of a need of capital, we will go out and raise the capital as a loan, as a corporate loan. And that actually what it does to my investors is that it allows them to participate in that loan, because that loan is going to pay about 12-14%. And have it as a priority on their equity. on everybody's equity. That it doesn't force anybody who may not have the money at that moment in time to participate, and there's no dilution of equity, because I don't like to dilute anyone. Right? People come in, they explain their money and stuff like that. I don't want to dilute anyone. By definition, if you create a corporate level loan, right, structured loan, then the money goes back to the loan first, and the interest rate goes back to the first. So what you really are diluting is some of the returns you might have had if that loan will not be taken into place. And so we've had a couple of opportunities where we had to take a loan. If you look at the last couple of years, 24 months, interest rate moved from 500, 600 basis points increase in some of the loans. And you have a 20, 30 million, $40 million loan, 60, $80 million loan to take an impact of 500, 600 basis points on top of what you're paying will definitely move the needle, right? Will definitely move the needle. Any additional year is a $4 million extra on an $80 million loan. If it's an extra 5%. And so, 5% less on the project, or 5% that needs to be arranged now, right? Another $4 million needs to be arranged. Things have gotten much slower during the pandemic. The conditions of getting material from anywhere out in the world was extremely hard. So things gotten slower. So here you have interest rate longer, interest rate higher. And so the interest rate eroded some of the values. The lucky part, of course, is that, a lot of the values have increased. And so there was a balance in there. We did pretty well overall in our portfolio. We have a portfolio of, I think since inception, 26 properties. Two of them you have in the back of you over here.
Yep. Yeah, I was gonna say that, but
yeah,
this one is what is it? Florida, the Dania Beach, right? And this one is
Dania Beach. They're both actually are going to close. I'm sorry, not to close. They're going to open Q1 of next year. Cool. The one on the right is 293 apartments. That's a nice Class A apartment building. And we're expecting to get a certificate of occupancy later part of Q1 of next year. The one on the left is a 265 keys hotel with a lot of food and beverage called the Caesar Republic. That's going to be the first Caesar brand hotel without a casino in the United States. There's a lot of a lot of swimming pools and restaurants and a lot of great stuff that's going to be part of it. This is in Arizona, in Scottsdale. Both are great projects, wonderful projects.
I was going to ask you about that, like your buying criteria, or like how does the process work for you guys, for Astor as a company, when you guys find a project? I mean, like how does that work? Do you find a project yourselves, or you partner with somebody that has a project? Like, how does that work?
Yeah, most of the time, folks will come to us and invite us to a project or ask us to participate in a project. So the one on the left, for example, it's a company that has gotten into contract on a beautiful piece of land, went through the entitlement process throughout the pandemic, got the approvals, got the design, got all those good things, and then they were looking for partners to participate. And so we worked with them and we created a joint venture partnership. The one on the right is basically the same situation. Two partners. In fact, the landowner wanted to sell the asset. The buyer said, I'll buy it, but I want you, the seller, to stay in the deal with me and we'll build it together. They went through all the permit stage and eventually looked for a partner for equity. And so that's when we stepped into the project. So most of the time we will be invited to projects, and we get about 800 invitation a year, and we say yes to about 2% of those. Sometimes, not always, but sometimes we'll find something that's very interesting, very unique, and we'll actually go out to one of our partners and say, hey, you know how to build. Let's start investing together. We'll bring some of the money, you bring some of the money, and let's do it together. So it really is a function of, both, it goes both ways. Right. But mainly people come to us with their projects.
Like, I can see that. Yeah. Any specific places I know that you're national, but like, I saw that you're like investing in Arizona, Florida,
Yeah. So yeah, we love Arizona. We love Florida, of course, where our offices are in Florida and in New York City. We like New York still for specific projects, not all projects. Certainly not rental income projects where you have to come in and rent stabilization, none of that.
Yeah.
Look, we deploy capital in three different ways, either through a joint venture partnership or through preferred equity positions or through lending money to a project as a bank, right? So that's three different ways that we put money into projects. So it depends on the project. We'll kind of like underwrite it we'll look at it from a number of different directions until we'll find the right fit for us, and then we'll try to negotiate to get the best possible terms for us, for our investors. I think the magic of what we're doing, which is a little different than a lot of other companies, the magic is that we create collective bargaining, right? If you consider a typical situation, a developer will show up at the table and raise money through a number of multiple small-time investors, high net worth individuals. We come in as a collective with a large check, and so we negotiate better terms for our investors, and then we create a structure where we make sure that we watch how our development partner operates, how the developing partner, make sure that he's on time, he's on budget, and if he doesn't do what he's supposed to do, then we have the right to step in, take over, correct the situation, that sort of a thing.
Right. Okay. Okay. Great. So let me ask you one last question, Joe, before we close it up here.
Sure.
What gets you going? I mean, like, if you think about like what's really exciting for you right now for the near future, what would that be, and how can we, participate in that?
What really is exciting for me right now is the credit fund. For the last 6 months or so, we've been putting together a business plan and been perfecting it, doing our studies, and the concept of a credit fund for us is very exciting right now. A credit fund essentially is going to be our ability to put money to various projects, just like the ones you see in the back of you.
Yeah.
And to bring the kind of return that we're able to generate in equity or preferred equity only through credit. So in other words, reduce the risk and yet maintain very high returns. And we're able to do it because we have a relationship with an institutional group that is offering us a very big line of credit. And through this line of credit, we're going to essentially utilize some of our own equity and some of the line of credit in order to create what we call the arbitrage, the interest rate arbitrage.
Right.
And so that's exactly what's very exciting to me. Other than that, I mean, I think that there's a lot of opportunities next year. I love Dallas. I know you're operating in the Texas market. I love particularly Dallas. Areas that I'll be happy to take a look at some deals with you is maybe smaller deals where, there's going to be some management work and uplift and sort of like, improving the community that we invest in and making a much better product for everyone and creating value for our investors, for ourselves. Those are the kind of deals that I want to see more and more of. Of course, great projects completing next year. We're going to have a few. We're not going to sell so many next year, but we're certainly going to complete and kind of like stabilize a number of projects next year. So that's exciting as well. And I think the most exciting thing for me is going to see how finally the Federal Reserve will start dropping rates.
Yeah, let me let's see.
Fingers crossed. Fingers crossed.
Yeah, I'm not really waiting for that, but yeah, it's gonna happen. But it's gonna probably be stabilized more than coming down. But we'll see.
I hope it will come down.
Yeah.
I hope it will. I certainly hope it will come down.
Good. Perfect. Let me ask you one last question. Is there any
Sure.
other thing that you would like for me to ask you so you can talk about it?
I mean, listen, I think we covered a lot. So I think it's, it's a very, very nice interview.
Cool.
So I feel complete, I think we
Perfect.
covered all the stuff. And you see me, you ask me one thing, you get a 15-minute answer.
Right. Yeah, I see that. I see that. I see that. Perfect. No, thank you, Joe, for being here, and for letting me interview you. And
Thank you, Louis.
let's see what we can do together, in the future. Hopefully, next year is going to be it's going to be better for the amount of properties that are going to be out there. Having said that, of course, it takes time to underwrite the right deal. So that's why I was asking you about the buying criteria that you guys have, or like, the getting properties criteria, I guess.
Tell me which area, which market you specialize in. Where do you focus?
So I'm in Houston, and I know you told me a while back that you're not really in this market, but I'm in Dallas too sometimes, like,
Yeah.
we could do something there too. That's, I guess, the closest that we're gonna be for your type of buying criteria, I guess.
What do you do? What do you do in Houston?
So I'm in multifamily, but I'm way behind your steps, if you know what I mean, right? So in the terms of experience, we bought a property. It's smaller property that we manage ourselves. Like, when I say manage ourselves, we have a property management team, but we have to be on top of them, right? So and it's here in Houston. This is a value add property, and right now we stabilized. It took a while for it to be stabilized because of COVID and all the restrictions that we had here. A lot of people were supposedly getting their checks from the government, and when we bought the property, it turns out that they didn't have any checks coming from the government. So we had to basically evict them all and get that property cleaned out and, like, refurbished in some of the units that we
You didn't want to sell in 2021?
Say it again.
You didn't want to sell it in 2021?
We bought it in 2021.
Oh, you bought it in 2021.
Yeah.
Okay.
Yeah, we bought it in 2021, and I guess.
How many units? How many units was it?
This one is 17 units. A very small property for what you're investing in. But as I told you before, so I'm looking to invest in bigger properties too, right? So I'm checking out this property in Houston. It's 232 units. It's distressed. Not the property per se, but the owner is distressed because of, like, interest rates going up like so quickly. So he had a reset in the mortgage. So he went from paying like 3 point something to be paying like 9 point something in interest, right? So he's not paying the mortgage. So he's trying to sell the property before that gets to auction. But that's not really a deal for you guys. I know, because I already talked to your people. I already talked to Francisco, and he underwrote it. He said that that's not really, it doesn't really fit your buying criteria or your investing criteria. So, and then that's fine, right? But what I'm saying to you is that I'm looking for those properties. I'm underwriting those properties, and I'm here.
What was the issue with this property?
The issue with this property was the property management. This seller bought 48 properties in 2019. 48 properties. The guy had like $1 billion to invest.
Is that Indian guy? Is that the Indian guy?
No. The Indian guy, he lost like 4 properties, and that's all the properties that he had, and that's it, right? He basically went bust. Right. Now, so this other guy, he came from office, like the office space, and he cashed out like in 2018 or 2019. That's when he bought all these properties. Some of them are better than others, but of course it makes sense at that time to get just one property management company that was national, or that had a national presence, right? So these guys were big, but at the same time they wouldn't budge in terms of, like, either I get paid or I don't do any work for you, right? And I'm guessing, because I didn't know, I don't really know about that part, but what I'm guessing is that they stopped paying. I mean, the seller stopped paying them because they didn't have any money. So they
stopped paying the management company.
Sorry, say that again.
They stopped paying the management company.
That's what I'm guessing, right? So they said, you know what, I'm not gonna fill up the vacancies. So the problem right now with the property is the vacancy. The vacancy is like at 55%, which is really, really low.
5% vacant. Okay, I'll talk to Francisco, okay?
Yeah, but sure. I mean, like, and he told me that it doesn't really fit his criteria, and that's fine. I'm just telling you that that's kind of the project that I'm working on.
How much is the mortgage over
there? They owe 6.7 or 6.8
million.
Yeah.
On 203 apartments.
Yeah.
Okay.
I mean, it's low. I mean, like the entry point, I already made like a soft offer for 8 million. They declined it. They said that if we get to like 9 million, that it will be better, and that's something that he can actually show the seller. And still at 9 million, if you think about 9 million, that would be what, like
39,000 units.
It's 230,000
units.
What? 232.
Yeah, it's 40,000 units.
Yeah, it's 39 units. Yeah, like 38. Yeah.
Okay. What kind of location is that?
That's in Houston, southeast of Houston. That's where the refineries are, mainly. The bigger employers are the refineries.
Mm-hmm.
So these are people, and actually my property, the 17-unit property, is close to that to that 232 unit.
Okay. Let's take a look at it.
Yeah, you can take a look at it again.
$9 million is there. So what do you think this property could generate?
I'm thinking if we just focus on, because right now the average rents are at 900, so still kind of low, right? So I'm assuming that if we don't go up in rents for 3 years, which won't really happen, but like I'm saying, even if we don't increase the rents, all we have to do is just increase the occupancy. And if we do that, in a couple of years, maybe 3 years.
How much money is needed in CapEx?
I haven't been inside the apartments, but as far as I can see outside, there isn't a lot. It's an older building for sure. This is a building that was built in like.
I'll take a look at it. Not a problem. Take a look at it. I think that could be an interesting opportunity.
I think so too. Like, I was looking at using the same cap rates that I'm using to underwrite, which are like between 6.5 and 7%, like higher cap rates. Even if I use that, it gives me, if I get to 90% occupancy, the value goes from like, 9 million, which is basically what we will be buying it for, to like 18 or 20 million,
Okay.
So, but of course, that's pro forma, right? But that's kind of the plan. That will be the plan.
We'll take a look at the. I'll have a conversation with Francisco. We'll take a look at this and we'll see what we can do. When was the last time you spoke to the guy?
2 weeks ago.
Okay. Just touch base with him, ask him for the most updated information if you can, and let us take a look. Okay.
Sure.
All right. Sounds good. This is the market for this kind of stuff. This is exactly the market for this kind of stuff.
Exactly. That's the whole point of me being here, is just being out there too, right? And I think there is also a possibility there. The broker is actually in New York.
Mm-hmm.
And this is of course, this is a brokerage firm that is a smaller type of firm. They're not really that big. He found I guess they were doing the due diligence. He found this guy, and they've sold a bunch of properties for this guy already, right? So, but this guy doesn't really have a presence here in Texas, and he has more properties to sell. So I'm thinking, like, for the I guess midterm type of future, I would like to get into, if we buy this property or if we don't buy this property, we may end up buying another property from him, right? The only reason that I told him that I was interested in this one was because it was in Houston, of course. But he has more.
Sounds good. Let's let me spend some time on it, and I'll circle back. So let me see what we can do. Okay.
Cool. Perfect.
Alrighty. Listen, thank you. Good to see you, man. Good to see you.
Thank you too, Joe. Thank you too. We'll be in touch for sure.
My pleasure. I'll talk to you again soon. Okay. Probably next week. I'm gonna be in New York for a few days, so I'm gonna be in between meetings and stuff like this. But later part of next week, let's try to catch up. Put something on the calendar. We'll take a look at this deal. Okay.
Perfect. Excellent.
All
Let's do
right.
that. Thank you, Joe.
Take care, my friend.
Right,
All
take
right.
care.
Bye
Take
bye.
care.